trading, there are only two things that truly matter: liquidity and time. Everything else is just noise. Most traders don't fail because they don't know enough patterns. They fail because they don't actually understand where price actually needs to go. And that place is liquidity. Now here is the problem. A lot of people talk about liquidity, but very few actually understand how to identify it properly on a live chart. Even traders who think they understand it are usually marking the wrong areas. I know this by heart because I did the same thing for years. It took me a long time studying charts daily, backtesting hundreds of examples and applying it in real trades to understand how liquidity really works. It is not theoretical definition, not social media version. It is the practical version. So in this video, I'm going to explain clearly and simply. If you truly understand what I'm about to show you, your chart analysis will change. You will stop reacting emotionally to price moves. You will stop getting surprised by price reversals, and you will start anticipating them. Let me start with a simple question. What is liquidity? Liquidity is simply orders, buy orders, sell orders, stop losses, and breakout entries. Price moves because orders needs to be matched. These prices are driven by an algorithm whose main objective is efficient price delivery. That means price needs to travel to areas where there are enough orders to fill large positions. It doesn't just move randomly. For example, when price drops aggressively, what happens? Retail traders panic and sell. Stop losses below recent lows get triggered. Breakout traders enter short positions expecting continuation. All of that creates a large pool of sell orders. And if large institutional players want to build buy positions, they need sellers. So price moves into that sell side liquidity to fill those buy orders efficiently. That's liquidity in practical terms. And here is what most people miss. You can actually see where these liquidity pools are forming on the chart before the reversal happens. And that is what I'm going to show you. I will share 6 specific locations where I consistently find real liquidity sitting. These are not random levels. These are areas I have studied deeply over the years through backtesting and real trading. And I haven't seen anyone explain all 6 of these together in a clear way. So I suggest you to focus carefully. Let's go through them one by one. So our first strategy to find liquidity is defining specific low and specific high. In our example, price was on an uptrend for some time, and here it goes sideways. This is called price engineering. By doing this, they create specific high and specific low. After creating such range, above this specific high, there are buy orders sitting, and below this specific low, there are sell orders sitting. But our main trend was uptrend. After taking this sell side liquidity, price goes up. At first, price went up here, triggered all buy orders above this specific high. Then they pushed price down below this specific low. So below this specific low, there are pool of sell orders. So if you buy this price somewhere here, you would place your stop loss below this point. And this stop loss would be sell stop. So if they push price below this low, they will trigger all these sell stops. And institutional players will be counterparty for all these sell orders below this specific low. After they match their buy orders with these sell orders, price continued to go up because we were on an uptrend here. It was just paused. They created this range, they engineered price, they manipulated both sides up and down, and price continues its uptrend. And our second strategy to find liquidity is using moving averages. For this strategy, we will use MA ribbon. Here is my setting. So the green one is 20-day moving average, yellow one is 50, blue one is 100, and red one is 200-day moving average. So why we use this? Let me hide this. So price doesn't always aim specific high or specific low. For example, if it's trending price chart like this one, it doesn't come down always and take specific low as it did here. So price pushed down, aimed this specific low's liquidity here, but afterwards for the second time it didn't take this specific low's liquidity. So you cannot catch such move by applying traditional liquidity strategy. Price didn't come down here and take this sell side liquidity again. Let's clean. So in such case, to define liquidity, I use moving averages. So if price is on a strong uptrend like this example, every time we trade below these moving averages, it will go up. So as a first target, you can aim specific high. But if price is making sideways, you can aim above these moving averages. As you can see in the example, every time it goes below these moving averages, here, here, and here, it pushes back up. Also here, after making this high, price got strongly rejected from this high and pushed below these moving averages. After taking all this liquidity of moving averages, it pushes up above these moving averages. As you can see, it got rejected above all these moving averages and pushed down again below all these moving averages. And price accumulated for some time and it continued its uptrend. So our third strategy for finding liquidity is that defining big figure numbers. What do I mean by that? For this strategy, I will give you Nvidia's stock chart as an example. As many of you know, Nvidia is the most valuable company. So everyone was waiting for $200 level, for example. If you define this level, price push up above this $200. After clearing buy-side liquidity here, it pushed down below this specific low. This doesn't mean that price cannot continue its uptrend, but it's very likely that it might pause its uptrend here, because all retail investors' interest was above this $200. When it pushed up, people started believing more that it will continue its uptrend. So they placed more buy orders above this $200 level. So what institutional traders do here is that they partially take profit above this $200 level, because most likely they built their position below this low. After such long uptrend, price needs to pause. As I said, it doesn't mean that we will continue to go down, but make sure that don't be bait in such big figure number level. So our fourth strategy is defining opening levels. Based on the time frame you are trading, you need to define daily opening, weekly opening, or quarterly opening. In this example, we are looking at a 3-monthly time frame. As you can see here, there is a bearish order block. Price pushed down, regained the level that has lost here. So this means this bearish order block became bullish breaker. And when I look at this up candle, this is October quarterly opening, which is fourth quarterly opening. I will define the opening level of this candle, and you can clearly see after price push up, it comes down to retest this area. It goes below this quarterly opening level, and after retesting, it bounced back and it continued its uptrend. Our fifth strategy to find liquidity is that following earning releases. This is JP Morgan stock chart. As you can see at the bottom, on 14th of October, they had quarterly release. I personally don't prefer trading before or after quarterly earning releases, because these are highly volatile days. Even though they had positive earnings, price came down, pushed below the low of the day of their quarterly earning day. So let me explain why it happens. After this positive quarterly earnings, retail traders jumps in and buy this asset here, because they believe price will go up. It slightly goes up, but they push price below this low, because if you buy this asset on this quarterly earning release day, you would place your stop loss, which is sell stop, below this low, and price comes back down, cleans sell side liquidity of these earning releases. They trigger sell orders. After sweeping the low, it goes up. So our sixth, last strategy to find liquidity is that defining extreme price points that will scare you to long or short. So for this example, I will use S&P 500 index chart. So in this example, price was on a downtrend for so long. This was 2008 mortgage crisis. Price pushed down for the last time and created this specific low. In this kind of charts, they create such fear so that you cannot even touch it. You cannot catch the reversal. This kind of liquidity hunts cannot be only one tick here and goes up. It pushes down here for the last time, and they convince people that it will continue to go down. In such cases, I want you to focus the origin of the last leg down. So here was our origin, this green box. After this up candle, price pushed down. They manipulated everyone that price will continue to go down. But after taking this sell side liquidity on the left, it regained the level that has lost previously here. To define such manipulation, use this logic. If price is regaining the origin of this down movement, then this down movement was fake. If it was weak enough, it wouldn't come up here and regain the origin of this down movement here. You can clearly see after regaining this bearish order block level, price continued to go up. So I hope you enjoyed this teaching. I believe no one is sharing this kind of useful information. Share what you think in the comment section and like this video and subscribe if you want to see more teachings like this. See you next time.